Hi there, everyone. Welcome to Admiral Markets. My name is Chris. Nenad is, of course, with us as well. Together, we're going to take a look at discretionary trading, see how we set up the professional analysis, and what you might find interesting for yourself as well. That's going to be the focus of today. Before we dive into the topic, though, be aware that the webinar is shown to a global audience. Doesn't mean that it's suitable for everyone, though. Take a look at admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity for more info about that. Also, please be aware that trading for exchange and global financial markets, trading it is considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you're aware of the risk involved when trading. All right. Thank you so much for your attention. So before we kick off today's topic, just wanted to let you know that in April and May, there's a special opportunity for existing and new traders that join or are with Admiral Markets already. So if you're already trading with Admiral Markets, that's valid for you too. And if you're not, that's valid for you too. So basically for all traders, a deposit bonus up to 50%. Just go to admiralmarkets.com. Click on Get Your Bonus, and you'll see all the details, terms. You can click on a slider that shows what your bonus would be, depending on what capital you would add to your account or after creating your account. All right, so take a look at that. That's very interesting, I think, at least to see if it's something for you. And for others, I'm sure that you want to benefit on this opportunity in the next 2 months. All right, so that's the first thing. Make sure to take a look at that after the webinar. All right, so let's kick off this webinar. Well, basically, discretionary analysis obviously is a way of looking at the chart without a. It does have rules. You can use rules and guidelines, but it's not 100% everything down pad. You have some leverage or space to basically interpret the charts and make decisions based on that interpretation, right? So it's basically you emphasize analysis more than a very rigid set of rules, right? So that's discretionary analysis. Now the advantage of that is that basically it keeps you more flexible in trading terms, because if you have a very fixed set of rules, right? It could be great, but how about if the set of rules don't perform as good as they did 2, 3, 4 years from now? What do you do then, right? So you kind of like are vulnerable to a market change in a way. Now, if you have discretionary analysis and you're able to understand the market patterns, you're better to adapt to new developments, and you're just generally speaking more able to spot better trades, higher setups, and or higher percentage profitable setups, right? The setups that have a better chance of succeeding, you have a better understanding which ones those are. Now, it's tempting to kind of look for the Holy Grail and say, okay, if I find a good combination of indicators, I add another indicator and I get rid of a few losses there, and you start diving into details, right, about the perfect equity curve, and you backtest it for a year and it looks fantastic, and you start trading it in real life and all of a sudden, boom, nothing, bad, right? So that's kind of a major pitfall if you're one of those traders that think, oh, I'm going to just test my holy grail and I keep improving it so much that I find the perfect strategy or the perfect system. And you might be annoyed or not in the mood to learn technical analysis or discretionary analysis because there is, some learning curve to it, right? And you think that this is a shortcut. Well, unfortunately, I'm scared you're going to be disappointed at sooner or later, because in a way it's just trying to skip the process of learning how to trade. And it might work for a while, but sooner or later you're going to bump into you're going to have an optimized strategy for a limited time frame. And as soon as the market changes its patterns, you're not able to adjust. You're not able to read those patterns, and you just it's gonna end up bad. So do take the effort to learn technicals, to learn discretionary trading. Even if you don't use it as much as I do, you'll still be able to better judge your non-discretionary strategies. So there's a lot of value here. Even if you are a algorithmic trader, still knowing this helps a lot with finding the better algorithm strategies. All right, so okay, I think I made my case why this is important. So let's move on and talk about the main idea behind this analysis. The idea is that basically the core concept here is that price follows the path of least resistance. So there's always, why is price moving up or down, and this kind of debates, and I don't want to get into that. All I know is that if price is moving up, that was the most easiest way for price to move to. And it's similar like a river, as I write here. Basically, if the river bumps into a certain terrain that is difficult to go through, and the water is not that strong, then it would go around that terrain. That's its path of least resistance. But how about if there's a massive body of water and just a small rock? Well, it's going to go plow right through it and push it aside. So at that point, the momentum of the water is actually stronger than the resistance, right? So for us analysts, it's important to determine what is that most likely flow. All right, so if you're on board on that, if you agree with the concept of the path of least resistance, then you want to know what is that path, right? Now, if you don't agree with that, by all means, let me know and we can have that debate. But for the moment, that's the core concept, the idea. Now, how do we do that, right? Arne is already asking. So we do that, and that's going to be explained in these slides, and then we'll take a look at the live charts. We do that by comparing energy versus resistance. And with energy, the flow of the water, I'm talking about trend and momentum. And with resistance, I'm talking about support and resistance. All right, so I'll just give you a second for that to sink in. And so I hope that's clear. So basically, energy versus resistance, the same like a river. With the energy from a river, it's the flow of the water and the strength of the water and how wide that body of water is. And with resistance, that could be the terrain, rocks, right? Mountains, etc. So for price, right, we're talking about different things, of course. We're talking about the trend, so we're talking about price showing higher highs and higher lows, for instance, right? With momentum, we're talking about strong, clear candles going into one direction. With patterns, we're talking about chart, wave, and candlestick patterns. And with resistance, we're talking about support and resistance, like tight tops and bottoms, like Fibonacci levels, pivot points. All of these are examples of support and resistance. So that's why I have a three-step analysis, right? Trend, patterns, support, and resistance. That's the triangle, my core way of looking at the charts. It's quick, it's simple, in my opinion at least, and cuts to the chase, and you get all of the core data, core kind of info you need or want from those charts. So when doing that, how to find out if a currency pair is interesting? Now, basically, it's all about comparing what your trade plan is looking for with the current market environment. So, for instance, if you're looking for a trending environment, right? Like I am actually, I'm a trend trader primarily. So if the market is not trending, I could cross out that currency pair, move on to the next. Very simple for me, right? If it is trending, that's great. That means that I can continue investigating that pair, and I can look at some patterns and see if there's maybe a reversal pattern at the fib, or if there's some continuation breakout of a bear flag. All right, so that could be a pattern I find interesting to trade. And then I check support and resistance. Is there a major level nearby? If yes, might not be that good. If not, another green light. So you get the picture, right? I'm looking at all these three elements and checking basically what is my trading plan and how is the current situation for all these three items. And if I get a green light for all three of them, well, that's what I want, right? But if one of these three or all of these three are red, then red light, then no. And of course, I don't have to look at all three if, first of all, the first one is not good, right? Now, I'm not necessarily ignoring all reversal trades. I'm just giving you an example. I am heavily focused on trends, though, right? Alrighty. So when the trends are okay, the patterns are okay, yes, interesting. And basically good to go. I should use actually a green check mark, right? So how much space is there when looking at support and resistance? How much space is there to the support and resistance? Is that a wide open space? Or is that just a small space? And it's also relative to the time frame, right? Because if you're looking on a 4-hour chart and there's about 50 pips, that's not much. But on a 5-minute chart, 50 pips, well, that's a lot. So that also depends on the time frame. Why? Because that also has to do with the stop loss placement and the R2R potential. So obviously, an R2R potential of 1 would be good. If it's 2 to 1, even better. Now after that, it's good to identify decision zones, what I call decision zones. So let's say the trend is there, patterns are okay, there's enough space to the support or resistance, right? So all of that is on a green light. So what's the next step basically? Well, at that time, I'm going to identify and look for decision zones. What I'm looking for basically is an area where price can get to that I say, okay, this is a bounce or break spot at a key level. Let's say price is in between a 38.2 and a 50 fib. So the 50 fib, that's a decision zone, right? Price is going to bounce at that or break it. Now, when I have that, when I see a zone like that, obviously it gets stronger when there's a point of confluence or point of control. So if there's not only a 50 fib, that seems like a good fib to me, but there's a pivot point, there's a trend line, obviously that decision zone only becomes stronger. There's a moving average, okay? So that only intensifies that decision zone. So this is the last slide and we're going to move on to charts, so bear with me. Basically, what's my trading plan? How's the market looking like? When you check all three items, good to go. I set up my decision zones, okay? And then I'm waiting for price to reach those zones. That's the part where I'm planning the trade. And when price gets to that zone, that's the part when I'm trading the plan. So the slogan, as you probably know, right, is a famous one, right? Plan the trade, trade a plan. Very famous. Well, that's basically when I have those decision zones, this slogan is then very useful. Basically, the analysis, setting up those decision zones require thinking, right? Require comparisons. But when I have the plan basically ready and I plan the trade and I'm waiting for price to get to the zone, then it's actually at that point I want to turn down the thinking cap or put it away for a second, put it in my bag, and I want to actually be prepared to react. So I change gears in a way, if you like, and I want to become more reactionary. I want to think less. Of course, I'm not saying never think ever again. can still think about whether the setup makes sense. Sure, but I don't want to overthink it because uh, you don't want to talk yourself out of a trade when price gets to that decision zone at the last moment, because that's probably more of a fear-based reaction than a really analytical kind of approach. That's why you want to tune down that thinking cap and be more reactionary and really just follow through on trading the plan. All right. So often enough, I talk about price reacting at. I look for instance, a price reaction, a candlestick pattern at that decision zone or POC zone. And I can give some examples in just a second, right? So let's do that right now. We got some good examples, I think, from this week. We got 2 live webinars on Tuesday, Wednesday, and I think we got some good examples from that. Mind you that that analysis done on Tuesday, Wednesday was all pre-fact. Now we're looking at it after the fact, of course, but at that time, anything I said was before it happened, right? Just to clarify. So Aaron is asking, how do you identify, for instance, the trend? So I would recommend taking a look at the YouTube channel because we do have specific YouTube videos for, I would say, all of these items, patterns, support and resistance, and trend. And I do use EMAs indeed for the trend. Yes. I'm not going to dive into too many details here because I want to actually make a summary of that instead of diving into one of those specific topics. But EMAs, yeah, indeed. So we'll talk a bit about that as we go along. So let's take a look at the dollar yen, for instance. Those was one of the pairs I found most interesting this week. If you joined the webinar, you knew that, or you know that, sorry. And it's been showing a lot of interesting patterns. Now, one key note is that there has been already substantial momentum and downtrend on higher time frames. You can see the red arrow there, where there was a big bottom break and a big trend line break. So definitely trend was down. Then if you look at patterns, well, we had a contracting triangle here, as you can see. All right, so that broke. Then we had a triple bottom. So we got a corrective channel after that triple bottom, but that channel broke. So another corrective pattern broke, a bear flag broke, right? So those were all kind of patterns we saw already before, and we talked about that in previous weeks. This week specifically on Tuesday, I was saying, look at price. This was happening right here, I think, on Tuesday. I said, we want to see a clear break, and the break would have to be a clear daily candle. That was my decision zone, basically, right? Because we had good patterns, we have a good trend, but on Tuesday, basically, we were right at a support level. So that was still not broken. So that's why I said we need a break of that. That was kind of my decision zone, and the break has to occur with a good daily candle, a close near the low. And once that happens, we can wait for a bit of retrace, what happened indeed on Wednesday, exactly at the 50 fib. I was talking about 38 to 50 fib at that time, after which price there's a good chance of continuation. So as you can see, that not to really don't want to pat my shoulder here too much, but you can see exactly now what I was talking about, though, at that point, right? It's always maybe difficult to envision that, perhaps if you're starting out, but now you see that in retrospect. So that occurred. We got a good close. I was talking about within 30%. The candle closed within 30% of the low. It was 25%. All right, so this wick is 25% of the candle. That's what I'm talking about. So a good break. So what happens when that break happened? A, the trend is still alive, right? Obviously to the downside, that stayed the same. B, we still had a good pattern break. Why? Because although we had 1, 2, 3 separate patterns, generally speaking, though, all of this was one pattern on the daily chart. So those 3 patterns together made one pattern. And that is actually a descending wedge, which got broken by that daily candle. So trend in place? Yes. Pattern broken? Yes. Any support or resistance close by? Nope. Support just got broken. So we got green light for all 3 at that point on after Tuesday. So on Wednesday, it was all ready and all set up for good shorts. In my opinion, obviously never ever a guarantee, but statistically I thought it was a good chance that we could get follow through, and we did. So other areas of shorts could have been here, but not on a 4-hour chart. Why? Because this zone, you see this zone, the blue area, the blue circle there? What's wrong with that blue circle there on this daily chart? Does anyone have an idea? We have a downtrend, sure. We have a triangle, sure. But that blue zone, what's missing here, you think, for this particular daily time frame? Bingo. Great job, Marco, Maria, and anyone else who thought about that. Zone is small. Too close to support, at least on the daily chart. So if you look at the 4-hour chart, doesn't mean that the 4-hour chart couldn't be a good break, right? And on our hourly chart, that could have been a very good break. But on the daily chart, I wouldn't trade that on the daily chart, right? That was one pattern. Then this pattern broke. Then this pattern broke. Then this pattern broke. Got a lot of patterns here to the downside. So on the daily chart, though, this was the daily break. On a 4-hour chart, or maybe an hourly chart better, right? We had this bear flag, that broke. That was okay because there was still enough space. This space compared to risk, yeah, that's fine. That's perfectly fine, right? So that was a good hourly trade, or even a 50-minute trade, perhaps, etc. Tuesday, we had that daily candle, right? Right here. So yesterday, and this fib is actually on the daily candle, mind you. Okay, this is the fib from on the daily candle. On a hourly chart, it looks like this. So yesterday, basically, when price retraced to the 50 fib, I said there are 2 trades off of these fibs, either the 50 or the 61 or the 78.6 fib, the stop loss here, or the break of the flag with the stop loss tighter above this high. On the daily chart, we saw price retrace that daily candle, right? That info basically translated on a 30-minute chart. We see a triangle, we see a pullback to the 50 fib, and we see a break of that triangle. So we saw the break of the triangle, and we've been moving down ever since, in fact. And my main target was 108.07. We bounced off that, but still made a bit of a lower low at 107.70. My target was 108.07 though. So let's see. So basically, this was a pattern below the break. So if anyone is, looking at lower time frames, we had basically trend in play, yes. Pattern, yes. Any support or resistance close by here? One could maybe think about 110. So if you're worried about that, I was not worried that much, but if you were, then here could have been 30-minute setups as well for continuation, right? Because this was a bit of a pattern here as well. So that depends how you judge those things, right? For me, the daily breakout was enough basically to take that trade. All right. So all those things were available. So that's it. The decision zone, though, for a 30-minute trader, right, could have been, for instance, this fib or the break of that fib. So basically, once you have all those 3 things available. I think we talked about that enough for the moment, right? So I think it's clear once you have those three things lined up. The next is talking about decision zones. In the daily candle example, the decision zone was the retracement of the candle. On a 30-minute chart, we could be talking about the fib or about the break of the triangle, right? So let's talk a bit more about decision zones and use a different example. Let's see what could be a good example. Maybe, okay, maybe the pound odd. Why not? We can go to the euro dollar just in a second as well. But before I dive into that, Maria says her target is 105.90, and I think that could definitely be very, very true. I mean, if you look at the momentum, maybe just quickly back to the dollar yen then. If you look at the momentum, indeed, this is accelerating away from the 21 EMA. Indeed, iron, it's 21 EMA close. So I think that after a bit of a bear flag, it's setting itself up for yet another short, in my opinion, in continuation. Let's see. So this is a good criteria to set a rating system to enter a trade. Yes, these are the main criteria. Now, how you basically, let's say, use those criteria. Everyone's going to use different supportive resistances. You might use different trends. You might use different patterns. And that's something that I'm just giving you the building blocks, and then it's up to you how you use those and interpret those building blocks. I have my own way, obviously, and I talk about that in the webinars. But that's up for you. Good. That's all clear. Great. So good question, Nathan. And how do you calculate the target area? Maria's asking to next support. Well, and that's up to you, but I use fibs. I use, if there's clear, strong, if there's a long pattern, a big pattern, I use the bottom. I use trend lines. I'm moving averages. So even pivot points as well on my systems that Nenad and I trade called HARP and AcuPP. All right, so pound odd example. Now this is actually a reversal example. Why did I think about reversals on the pound odd? Well, there were divergence patterns. There's triple divergence, I think. Definitely a double divergence here. Let's see. 1, 2. Well, I would say triple divergence. All right, on the 4-hour chart. That was the main reason. Maybe there were other reasons, but let's keep it focused. So triple divergence, I think, is just on its own a good reason, right? So reversal territory. That is part one. Part two was the divergence pattern. It's kind of linked with each other, and support and resistance story, right? So basically, I was looking for price to get back to these deeper fibs to use this support, and basically traded up to this target. So from a support or resistance point of view, from a space point of view, there was actually a lot of space, because if I'm trading it off the 78.6 fib with a stop loss here below the bottom and targeting here, obviously the R2R is a good. The R2R space kind of part is more relevant with trading breakouts and bounces, not counter trend bounces maybe. No, sorry, counter trend with the trend breaks. Now I'm getting my terminology mixed up, but here obviously the space issue is not so relevant, because you got a lot of space and you got small risk. In these types of trades, it's actually more about how often will this setup work out. And that's something that might need a bit of experience to estimate that, right? Because the R2R is definitely here. All right, so with the analysis aside, 3 green lights, all right? Looking at decision zones, I was looking for deeper fib, right? So this whole green box area, these 3 fibs, is where I would consider my decision zone, and I would be interested in potentially trading that. So if we go back to quickly to this slide, my step now would be waiting for price to reach that zone, right? And then once it gets there, reacting to it. And then I said I'm like to see price react to that zone. So what I'm waiting for is often a price action signal, a candlestick pattern, like the one with the green circle there. A pin bar, bullish pin bar, and I like that pin bar. Why? And this is maybe a different webinar kind of topic, but why did I like it? Well, first of all, bullish. Second of all, we had a series of bearish candles, so it's not just like a pin bar in the middle of a move. No, it's actually very good downside move. So that's important. We had a downside move. We have bullish bar. We have a decent wick, and the close is above the previous close. So we got all four things available here. So this was a good bullish pin bar. So the point is that there's a clear confirmation, in my opinion, in my decision zone. That's what I'm waiting for. An entry right there, or a small retracement of that candle with a stop loss below it or below the bottom, and a target right up here, or a partial target is also possible, more conservative target, lower perhaps where the pivot points are, and here is also possible. In combination with the trail stopping any strong candle would actually effectively already mean that the trade is close to some profit, or at least break even. This candle is not closed though, so break even. That's basically price waiting to get to the zone of action and then reacting to the confirmation. That's how I like to trade, but doesn't mean that everyone's the same like that. Others might trade differently, but the concept, this is just an example, but the concept is, right, the analysis, the 3 steps, the triangle, support and resistance, trend, and momentum, and patterns. Then decide what the decision zones are and the point of confluences, and then wait for price to get there, and then trade that or not. Trade that decision zone or skip it. That's basically the flow of my way of discretionary analysis. Okay, so well, I guess that was my part. Let me pass it over to Nenad. Let's see if I can reach him here, and I'll switch over to charts. If you have any questions, of course, yeah, we do. You entered such a trade direct on fib or on a break of the candle. It depends from trade to trade. With the pound odd, I'm not trading it at the fibs. I'm waiting for this pin bar to close. I'm trading that pin bar. It's even possible, indeed, to trade the break of that high. I didn't do that, but that could be another way. Indeed. Break, pullback, continuation concept. Indeed, great idea. Sometimes, if it's a trend, I might place a pending order at a fib. But I really have to like the trade a lot. For me, pending orders is only when I really think that the probability is extra high. All right, so let's see if Nenad is, if I can reach Nenad.
Thanks, Chris. Lovely as always. So today I will show you, just continue where Chris left off, and I will tell you a few things before I move on to live charts. So about technical analysis, why you should use technical analysis, and how to actually distinguish from actual analysis and trading, because it's not the same thing, analysis and trading. Those are different things. Technical analysis is in contrast to fundamental analysis, usually, if you go with day trading. The point is, why it's like that is because day trading is usually influenced only with news, and those news are just short-term data that show every day or every week, so it's not that important for investors. Investors look for general cues about rate hikes, about general policy guidance of central banks. So that is what investors do. Traders don't look at it so often because you know, one day because of FOMC, let's just say, for example, euro dollar will go up and next day it will go down. So we traders don't care really where pairs will go. I personally don't care if euro dollar or pound dollar or Swiss yen will go high and low. My job is to, as a trader, is to set a trap and actually trap the price. By trapping the price, I'm hoping to secure the pips that will turn into profit. So you need to distinguish between analysis and trading. Okay, my primary thing is what I do with other markets is I do the analysis. Okay, I do the analysis, but also I do trading, because what I analyze I tend to trade. And the thing is, those setups that I do are also setups for you, and you can read it. But the thing is, it's intraday, it's intra-week. So you can trade it for a day or 2 days, 3 days maximum, and then setups will change. Sometimes setups will change for in the next day or maybe next few days. Usually they're valid for 1 to 3 days. But the thing is, it's nothing compared to long-term or mid-term. Investors don't, they simply don't take a look at intraday charts. They want to know where the pair will go in 6 months or next year or 2 years. So I'm not interested in that. I'm not an investor in that sense. I am a trader and analyst, and I don't care where the price will go, because I will be trading both shorts and longs. 1 minute I can go for longs, the next minute I can go for shorts, or let's say the whole day I might be shorting the rallies, as I did with pound dollar today. I shorted 3 rallies. Almost, the first one almost hit POC, but as soon as I saw it, it was 15 pips below the price. And as soon as it went up, then started to retrace, I enter a short trade. So for me, it's simple. Today I was short on pound dollar. Maybe next time I will be long. Who knows? Well, that is what we do, analyze the price. So technical analysis is very often totally opposite to fundamental analysis. But don't just judge that difference between technicals and fundamentals on intraday charts, because when they align, there can be very powerful allies. I always say the best is when we align both technical analysis and fundamental analysis. If fundamental analysis is aligned with technical analysis, it's actually great, because then you need just to use your system for technical levels, and you will know where to enter a long or short. So if fundamental analysis say, okay, it's time to short pound yen, well, you just take a look at your system and see if you go for pound yen short, and vice versa, right? But usually what can happen is that intraday analysis is subject to a change because of the news. Okay, think about this. All the information is already reflected in the market's price. All the information. Now, if the news come, for example, you know that the trend is to the short side and you go short, then suddenly there is a new spike. Okay, the price might go like this, and you might say, okay, it's time to go long. No, because all the information is already reflected in the market price. It's just a retracement for new short. It happens almost all the time. You think the price will go up because it's a huge up candle, but the reality is different. Is that it's time to sell. Okay, so that is the advantage of technical analysis. When you know what to do, you can cherry pick the levels. On day trading, and for day trading, definitely technical analysis is suburb compared to fundamental analysis. The only problem lies if we see central bank intervention and news releases. That is why we tend to put a stop loss before the news, or we just wait for the news spike to fade and enter based on a trend, right? Because price moves in trends. What is a trend? The trend is trust pullback, trust pullback. Same for downtrend. It will repeat itself. And you can always flip your charts to the left, watch historical price action. Well, in fundamental analysis, there is no such thing as history repeating. Of course, there can be repeating, but usually when we will see another rally on euro dollar to 1 point, if you remember, 1.56, like in 2007 and 8. Well, it was due to fundamentals, because US, about global financial crisis, mortgages. When mortgage sector suffered, euro dollar spiked up and euro was very strong. Well, will it happen again? I'm not sure. I won't be guessing. Look at those banks, guys. Look at their predictions. They are predicting where the price will go like a year ahead. How can I know where the price will go a year ahead? I don't know what will happen in a year. Anything can happen, right? So I would never dare to actually make those kind of predictions. It just doesn't suit me. It doesn't suit my style of trading. I don't like it, really, to be honest. I just want to know where the price will go at this moment or next 5 days, and it's okay. So intraday analysis should always be made prior to any potential trade in the market. That is your primary step. It's good. Fundamental analysis, excellent. Well, based on fundamentals, right? You can always wait for technicals and see what they show you. But the thing is, do the technical analysis before you enter the market, because fundamental analysis will not give you the entries. It won't give you levels. It will just give you general bias based on something that happened, right? Get to know the pair which you will trade. If you want to trade pound yen, well, get to know pound yen. It's totally different, guys, to euro dollar. It moves a lot and it's very, very strong. So I would never dare to enter pound yen, because if I don't know what I'm doing, it can be very dangerous to trade it. Okay? So think about it. And do not overtrade. Never, guys. Do not overtrade. Because if you do, the chances are you might suffer a loss instead of a win. So never ever overtrade. Try to be realistic about the price. Okay? Always try to be realistic. That's of utmost importance. Okay? Respect and follow your charts. Respect and follow your charts. Your charts are your own tool. So respect it. Don't think that other charts are better than yours. Okay? Respect it. Check your calendar. You don't want to be in conflict with news. Check your calendar. It's also very, very important. Don't trade 30 minutes or 15 minutes prior to big news. If you're stuck in a trade, then wait. Well, what you can do? Wait and put a stop loss. Unusual spike in the price is probably led by some news. Yes, you can also hedge, Nathan is saying. Indeed, Nathan. You can hedge. and then wait. Release your trade once you're sure for direction. The price tends to correct it after the news. So usually you will see a spike, but there will be correction and a new trend. Use fundamental analysis as guidance. For example, NFP. You don't know the technical level just by using fundamentals. So this is a guidance for us. And fundamental analysis can mislead you by spiking up the price. Did I mention? Yes, I did. Plenty of times before FOMC meeting. Euro dollar is bought on dips and it's in the range mode. It's same before FOMC. It is same during FOMC. Because those important levels that we have set up yesterday, they haven't been broken. 1330 is strong, 1435 is broken, but it hit our first target, 1450. Yeah, it was only 20 pips, right? But it was hit, but then rejected. So it's still in a range, and it's still sold. The pair is still sold out. So, you know, it's not that euro dollar is bullish. It's ranging. You need to distinguish between bullish and ranging price. Of course, as you know what range is, you can always go with a general intraday bias. So if the bias was to buy euro dollar down there, well, it's good. We will do that. Why not? Don't trade on bid rate days prior to NFP, stress test, Fed, on ECB conference. So you don't do that. How I do usually, I wake up just prior to London Open, like half an hour or 45 minutes. I do the analysis or I wait confirmation after London opens up. So I need to be sure what I'm doing. I don't want to guess, because guessing is not good. I want to be sure what I'm doing, and I want to be sure in my analysis. Okay, that is of utmost importance. I apply Fibonacci's, trend lines, divergence, chart patterns. I use Camarilla MACD for that purpose. And it's good because I can use my Camarilla MACD for general analysis and POCs, and then use, let's say, EQ pivot points or HARP. But I've been mostly trading EQ last couple of months, and go with my analysis. So if my Camarilla MACD tells me, okay, this is a short trend, I wait for POC, but fortunately POC was not hit, then I move on to EQ and go short, because my system and my analysis is always in accordance to trade positions. I won't be doing short analysis on pound dollar and then take a long trade on pound dollar on my system, because my systems are, every system is in confluence. So I'm patiently waiting, zooming in to lower time frame to have a precise entry. And I always wait for pullback before entering a trade. That is what I say always, wait for POC. Price usually pullbacks to POC and then we have a trade. If there is no pullback, I wait for a breakout. So pullback is trend trading, positional trading, and breakout is simply break of levels. MACD is my greatest weapon. I love MACDs. For EQ. For Camarilla MACD, those are POCs. If trade goes in contrary to my direction, it's usually a breakout trade. Because I have noticed that I can be wrong on breakouts if I don't take early profits. That is why I suggest going with scalp breakouts. So trade is broke, so the level is breaking down. If you don't wait for a retest, take a quick scalp and exit the market. It's the safest way to go. I always watch daily close. I always watch daily close. It's very important to me to see how the price will go. Daily close, if I see a shooting star, well, at important resistance, or if I see T89, those patterns that we use it on daily, guys, because daily chart is good for intraday analysis. Daily chart can give you a cue for next day. It can tell you, okay, next day is short or next day is long. Do it. For intraday analysis, then I do on 1 hour or 4 hour. So daily close and then the analysis. And then zoom into lower time frames or wait for POC. How I do it, for example, I always give you levels. It doesn't matter the time frame. Levels are on 1 hour and 4 hour. That is optimum for day trading. Maria, for day trading, I recommend 1 hour, and you can also do use multiple time frame analysis. 4 hour, 15 minutes, 1 hour, 5 minutes, whatever. But how I do it, I don't care when I use Camarilla MACD. I don't care whether I will make an entry or 5 minutes or 15 minutes, because it's not important, because I use POCs based on chart. So as soon as POC enters, as soon as POC is hit, I will take the entry. If the price is very short of POC, but I see, let's say on other system, like EQ, that it will go down, I might take an early trade. But for swing entries and intraday positions, I prefer a POC hit. I want to see POC, or at least very close to POC, and then I make an entry. The advantages of using analysis are, we are going with a trend, we are using market's momentum, and that's good when you align both trend and momentum. Orders have already been made, so we are following the big money. Okay, so you want to follow big fish. And history is repeating, the biggest advantage. History is repeating in Forex market. Disadvantage is technical analysis is subjective. The things can go wrong if there is news kicking in. And intraday analysis is much harder to do than long-term analysis. Because long-term analysis, no one will probably remember what you said a year ago. Who would remember what JP Morgan said a year ahead? I don't care really. I would probably forget about it. But intraday analysis, everyone reads it. Everyone wants to know where they can try to make an entry. And that is why, that is my favorite. I can say that I'm a big fan of intraday analysis, and that is what I do. So for this day, I give you levels, give you positions, I give you the trend. So I'm giving you the trend, the position, possible stop loss, read between the lines using my analysis. And if you see that sometimes price didn't pull back to POC, but use your own logic. You look at pound dollar. After the analysis, it went to 1.4115, and I predicted 1.413035, the bottom of POC. So it was very close to POC, and then it was rejected. But well, it doesn't matter. Use your own system, or I don't know, whatever, to find that short entry based on 41.15 instead of 41.30 rejection. Maria, POC is not reaching MA89. POC is the zone. POC is the zone where you can go long or short based on analysis. So POC, I will show you. So this is POC. So if the price hits this zone, if it enters this zone, you go for short trade. So these are basically like signals, guys. But of course, I cannot say it's signal, but it's the most precise technical analysis you will see. Other than that, if I say sell at 41.35 to 41.50, it would be a signal, and I cannot give you signals, nor I'm allowed to do that. It would be like breaking the law. I'm not allowed to give you any signals, but I can make the analysis literally just tells you, okay, go short here, go long there. This is what I do with POCs. And this is my technical analysis. Who cares what happened after? We can use it just to show that when I retweet my analysis, I always do it because something happened. Usually it's a good trade. And I'm telling you, okay, now watch this and try to read the analysis again to see why I made it like that. So you actually know why you should have gone long or short. And you won't be finding a lot of these analyses over the internet. They're usually very vague. They don't tell you always where a price might go, where you should place an entry. And this is a good form to actually explain. So this way you're actually learning about technical analysis, but you're also placing your trades. So that's very, very good to your general knowledge. And let's use a live chart now. So I will use examples. Okay, first one, pound dollar. So pound dollar trade, guys. Pound dollar setup. Yesterday analysis, daily chart. I always say watch daily chart. It's important for you. So yesterday daily chart showed like a bullish candlestick, right? Well, that's the tricky part. The candlestick was rejecting, but look at this. It broke through L4 and it's still M pattern here. So daily is a bit bearish to me. When I place the trend line, which is also visible on 4-hour time frame, it's very easy to see how the price is rejecting here. See, look at this. 1, 2, 3. Look, 1, 2, 3. This is bearish. This is not bullish. This is very bearish. Exactly, Nathan. We have a bullish pin bar, but it's not that important because what we see is actually a trend line break. You're right, because we have a trend line break. In this case, a trend line break told me that it was much better to use and to go with short trades. Then I moved on to 4-hour. Exactly, price action trading is cool. Then I move on to 4-hour time frame, and I did the analysis today. So read it, and that is based on 4-hour time frame. And you see, every rally has been sold. Every rally has been sold. Euro dollar 4-hour time frame. Okay, I did the analysis on 4th of April, telling you that euro dollar might spike from 13.30. What happened is it went to 13.26, right? Exactly to the POC and went up. The trade of the week from session recap trade is euro dollar, guys. Euro dollar, the trade of the week. Huge number of pips. But look, why? Because of this. Look at 4-hour at that time. So bearish. This is ascending scallop. Clearly bullish on 4-hour, right? Daily chart, look at this. Every single daily candle resisted L3. Pivot points. So bullish. Look at this. This is V-shaped reversal. V-shaped reversal. 2 V-shaped reversal, guys. Look, 1, 2. So why did I tell you to buy lower? Because both daily and 4 hours suggested the price will go up. But then you go to 1 hour, wait for a drop, because you're not buying here. You're buying when price is dropping. Okay, price dropped here. I could say, okay, you could go with buying this level here, but it tells me nothing. Really. Until this level here, I don't see anything. But it's too low, 12.20. So I needed to decide whether I would tell you to buy it 13.30 or 12.25. So my logic was, it's much better that if I tell you that you could buy here, because I didn't believe in a pullback towards 12.20. Well, it's not that simple, but the thing is, it was good, right? Another one, good winner, another winner on session recap, Australian dollar rejection from 75.70. If you remember session recap, why did I tell you to go long? Because guys, on that time frame, it was still, you see, it was still bullish. Look at this, still bullish. Daily candle here, definitely bullish price action, because daily candle here said, okay, we are at support, a lot of support here. Okay, a lot of support here. So zooming into 4 hour, I saw bullish price action. Zooming into 1 hour, I was telling you this. Okay, the price is retracing, it's below EMA, so we want to have a long entry. We have bullish price action. Of course, we want to have a bearish price action if we want to see a low entry. And low entry happened exactly at 75.70. See, but it couldn't break this level, so the price was rejected. But still, it was good for like possible 50 pips. Euro dollar, oh, I show you this, euro dollar. So that is how I do it. I always use multiple time frames, and a tip, watch daily candle. Okay, daily candle is very, very important to you. Then zoom in to 4 hour time frame, and you can also zoom into 1 hour time frame. Or how I teach you in price action training school, you will need to learn about a confluence, and that will be also that we will have more sessions. It will not be a single session about confluence points, because when we get to confluence points, I will make 2 or 3 sessions just talking about confluence points, because that is how I do it. That is exactly what I'm looking at if I want to make an entry, or at least to give me a cue where a price might reject. But watching higher time frame entries and zooming into lower time frame entries is actually very, very important. And you will not find a lot of people do that, because they simply tell you, okay, use 4 hour, 1 hour. Yes, I do it too. But if I want to if I want to do daily analysis, 4 hour analysis, I will always take a look at daily. If I want to do 1 hour analysis, I will always take a look at 4 hour and daily as reference. And then I identify POC, so I don't need to zoom into 5 or 15 minutes. I do that on AQ pivot points, because AQ pivot point is made like that, it's different. But on Camarilla MACD, I don't do that. I just watch confluence points. But it's subjective. It's not for everyone. It's very subjective, because that is how I do it. Maybe you see different picture. It's not this, okay? It's not like this, guys. We can see, let's say, I will give you a good example where we see the exact picture. We see here the same picture, right? Here. We see T89 to the downside, right? Well, we are right. We see the same picture, guys, here. Okay, great. 50 pips to the downside. Do we see it? Yes. T89. Do we see the same picture? Triple bottom here. Easy job. Do we see the same picture? Okay, let's see. And okay, T89 again here. Do we see it here? Yes. T89, a little bit draw down, then bang to the upside. Do we see an uptrend here, guys? We see it. Yes, we see the same picture. Uptrend, scallops. But what we don't see is entries. What we don't see is confluence points. What we don't see is trend lines and where to place Fibonacci's. Because every one of us see it differently. I will use Fibonacci from this point here, okay, this point, and you might use Fibonacci from this point. Why? Because you take this swing, but I'm watching that this was a swing, a mini swing, and this was also a mini swing. Mini swing high, mini swing low. So I would put Fibonacci here. Well, you see why different technical analysts have different methods and different pictures. So use what you think is okay and try to develop your own views. Nathan is saying by T89 you mean the break. No, Nathan, T89 is my proprietary pattern. When you see a pin bar rejection of EMA 89, it's T89 pattern. There will be a lot of T89s. Just use the first lesson on price action trading school. I explained T89s there. But generally, when you see rejections like this, these are T89s here. Okay, like this. Pin bar rejections of EMA 89. EMA 89 is very strong, and pin bar rejections can be very good. This is an excellent example of a rejection. Excellent example. Look, T89 pattern. The best T89 you can have. Pow, exactly like this, or tail like this. But this is what I like the better because it's sitting at support where you can buy it. It's a cue for the next buy trade. So guys, that was all. Maria is asking, where can I find the recording? That is, let me show you. Price Action Trading School, lesson number 1. Price Action Trading School, the channel, lesson number 1. So use this link and you will see it. The lesson number 1, candlesticks and trend, it's called. My proprietary pattern, I have made it up. I have discovered it. It works very, very fine when markets are at support or resistance. So guys, thank you for listening. I hope that you enjoyed. Have a great weekend. We will be here with you soon, as always. If you need any help, of course, we are here to help you. We are already over the time. And if as I say, if you need anything, just tell us. And next week, it's time for more webinars to come. So enjoy it and enjoy the weekend and rest of the week. Thank you, Tom. Thank you, Nenad, Doug, and everyone. Cheers, guys, and trade safe.